Hello, most likely you heard about some dependencies while trading during the summertime or any other period of the calendar year. That is, in some volatility is lower and in others prices do change more often. That is why we will today talk about the effects of a seasonal factor on the behavior of asset prices. We will discuss the role of seasonal factors in trading. We will answer the questions: how does season affect the psychology of traders, and then we will conduct analysis of price charts of markets in different periods of time to show the differences. But first, as always, let's roll a quick intro and then we will go straight to the topic. So summer is considered to be the hardest trading period with the exception of Christmas holidays. At this time, institutional investors leave the market to go on vacation, which is why liquidity is down, volatility is down due to the lower trading volumes. But when some big event happens, it can cause a strong move because of the low liquidity. But it doesn't happen that often. And so price behavior is less predictable then. However, this is how it works in theory, and reality is often a little bit different. Does the volatility and liquidity of markets really change in summer? Do asset quotes depend on the seasonal factor? Are there any cyclical seasonal patterns in the instruments of different markets? So we will deal with those questions as well. Let's start with the peculiarities of summer trading on the stock and OTC markets with debunking the myths. So summer is time of vacations, sea and sandbathing, anything but work. In summer, people want to travel, enjoy different types of leisure activities, forget about work and emotionally exhausting trading, and spend time with family and friends, at least for a little while. Does seasonal factor affect the assets? Well, traditionally in trading, summer is considered to be completely different from other periods and has a pronounced seasonal nature, lower trading volume and impact of institutional capital. i.e., large market makers also want to rest. Banks and investment funds let their employees go on holidays, private traders with large capital also prefer to go on vacation. So, do we have increased volatility during this time? This follows from the previous statement. A decrease in volumes means a decrease in liquidity. A buyer wants to buy an asset, but there are no sellers, and vice versa. Next, is the impact of fundamental factors lower in summer? The publication of quarterly reports of companies has a local impact, which is not comparable with the annual reporting and the development plans for the next financial and calendar year. Industry demand does not pressure on commodity markets, mainly gas, whose consumption is reduced in summer and thus do not put pressure on the price. It is different with the oil because transport uses a lot more oil during summer, especially jet fuel, but it is most often priced just before summer period because companies are preparing for it in advance. It seems to me that these statements are at least partially true. If you owned large capital and understood that the small traders are reducing volumes in the summer, would you not be tempted to push the quotes in the right direction? Moreover, a vacation does not cancel the possibilities of algorithmic trading. If we talk about fundamental analysis, its factors do not depend on the season. When we have a situation like this one where oil is scarce, it's not enough of it on the market and the price is high, then of course any publication from, for example, OPEC about the decreasing or increasing output will highly influence the market. So is there a difference between trading in summer and other seasons? So let's analyze one opinion which is different from most theories and try back it up with some stats. So this analysis may be of interest to traders who prefer medium and long-term strategies, keeping positions in the market from several weeks to several months. Scalpers can easily earn on minute trades at any time of the year. So should you radically change your approach to trading based on the seasonal factor? Most online resources describe summer as the most unpredictable trading period, comparing it to only with the New Year holidays. At this time, small speculators and some large traders whose plans are unknown are the only ones that remain on the market. Hence, the constant unpredictable breakouts of resistance and support levels, prolonged drawdowns, etc. This is a very controversial issue, especially if we analyze individual instruments on the different markets. I suggest that we start with the commodities. So commodity assets are unique because in addition to geopolitics and speculative factors, their price are greatly influenced by direct demand from industry. It primarily concerns oil, gas, metals, i.e. gold, platinum, copper, aluminum, etc. and also food, like wheat, beef, and so on. And to some extent, seasonal factors can play a role. Let us turn on the statistics again. First, let's start with the oil and the question, what is the volatility? So theory says that it is a range of price fluctuations over a period of time. Therefore, to compare volatility in a given season, we should analyze a long-term period without taking intra-monthly fluctuations into account locally. The price fluctuates in the range of $60 to $63 a dozen times in both directions, and we still consider this a flat, and these fluctuations are only of any interest to scalpers. What we can observe in the chart are strong price movements mainly in the fall. At the end of the 2016, from October to December 2018, and in June 2019, there was a decline, areas highlighted in yellow. The decline of June 2019, though not so strong compared with other periods, is an example of the fact that oil is volatile in summer. From March 2016 to October 2017, we can see a flat, highlighted with the blue square. So despite the strong internal fluctuations, it is still a flat in comparison with the subsequent growth in this time interval. A growing trend was observed from October 2017 to October 2018. And what is the conclusion then? In spite of the fact that in summer the oil reserves usually grow to the increased production, the price does not tend to decline, and there is no reason to speak of high volatility compared to the other periods. So which factors influence the quotes? At the beginning of the year, the balance of production and consumption is more influential, but in the middle of the year, the investors are more responsive to geopolitical factors. However, the pattern is not consistent. But one can definitely say that seasonal factors do not play the most important role in the dynamics of the oil quotes. The exception is the chart of quotation of natural gas. Unlike oil, it is not a strategic investment tool for investors. It's hard to explain why, it has just happened this way. So also gas has no correlation with oil, therefore the local demand and supply directly affect the price. If you look at the 5-year chart, you can see the pattern. In most cases, sharp trend movements began in November to February, whereas in the middle of the year, the price either continued the long-term trend that started or more often entered horizontal flat. Okay, so now let's talk about gold. I suggest we look at the quotes of gold from summer 2018. For the entire 3 months, the price confidently went down, continuing the trend that started in mid-April. So the end of this downtrend came in August, but I would not associate it with the autumn growth of business activity. If you look at the summer behavior of prices in previous years, you can see there is no regularity in the summer period, but the annual cycles are evident. In this screenshot, annual price peaks are clearly seen in December to January. In part, this can be explained by the fact that investors prefer to wait out the holidays in safe haven assets. In other words, the seasonal pattern in the gold chart is visible, but this applies exclusively to the winter period. It may not be that pronounced compared to other trend movements, but it should still be taken into account by careful traders. So the conclusion of this is that the concept of a seasonal factor is only applicable to gold when it comes to winter holidays. Next, we have the wheat futures. This instrument is fundamentally taken as an example to show that the seasonal factors still influence certain assets. This chart for almost 10 years shows a clear pattern almost every year. Pronounced peaks with a quick rollback to previous position occur either in January to February, these are the green arrows, or in July, the red arrows. A similar pattern is observed in the pork futures chart. There are usually similar peaks in June. I will not go into the details of the reasons, just pay attention to the fact that you can earn on such cycles. And conclusion is that the seasonal factor is very pronounced in food assets, which may be related to their production cycle. But such instruments are an exception, since seasonal factors do not have such a significant impact on other assets. You should also pay attention to the fact that these instruments have only peaks with a subsequent rollback. There are no seasonal lows. So finally, we go back to the stock markets, where in theory, seasonal factors affect stock markets as much as commodity markets. In the winter-spring period, there is a peak in the publications of financial statement and distribution of dividends. Therefore, trading in the stock exchanges is particularly lively. In the summer, no significant statistics are released. Quarterly reporting has a local influence and most people take vacations. But this is only in theory. This chart shows that regardless of season, the price went up steadily. There were fluctuations, but they happened in September, October, December, January, April, June, with no discernible seasonal pattern. Nasdaq responded to fundamental factors, but not to the seasons. It is possible that seasonal factors still affect the stocks of individual companies. For example, we can talk about large agricultural corporations, but retailers or technology companies, some of them have been selectively reviewed, do not show seasonal patterns. So conclusion of this is, working with the shares of individual companies, one should take into account the specific features of their activity. If we are talking about indices, summer trade is not really different from trading in other periods, with the exception of the annual reporting and dividend distribution period. So right now you probably guess that foreign exchange markets react to seasonal factors even less than commodity markets. If in the case of commodity assets there is at least a partial influence of the growth in consumption, currency trading in terms of the level of volatility is essentially the same at any time of the year. A minor exception is probably the Canadian dollar, which is affected by oil. In terms of trade volumes and the rate of a price change, in theory, there is a summer slowdown. Due to the decline in trading volumes, the price changes more smoothly. However, different analysts give completely different reasons for this. In summer, volatility of currency pairs increases. The buyer making the price cannot find sellers for a long time, so the liquidity levels decreases. And vice versa. In summer, volatility decreases, trading is weak as the numbers of traders decrease on the market. Which of these arguments is closer to the truth is a rhetorical question, I think. But you can definitely say that in summer the price behaves less predictably. According to S&P research, the worst month to trade is August. Analysts say that the strength and direction of the trend are set by institutional investors who go on vacations in August. Small traders just rock the boat in different directions. Trade takes place in a relatively narrow price range and is accompanied by constant ups and downs within it. In this chart, the EURUSD pair shows both trend movements and a flat. If you look at dates, in some periods the trend movement occurred in summer, which is the yellow segment, and there were no sharp price fluctuations, as in the subsequent period they happened. But the next 1.5 years long segment, the blue line, can be called a partial flat with constant price fluctuations. However, it is in this section that we can see the influence of seasonal factors. From October to December, two sections show a pronounced downtrend. But in all fairness, I should note that in 2017, the trend of the autumn of 2015 and 2016 did not repeat. A slight decline in October was followed by growth in November. The section is highlighted with a yellow circle. And the next price surge came in the spring. So in 2018, the effect of seasonal factors was not visible from the chart. And now let us look at the USDCAD commodity pair. The situation here is even more interesting. So in 2016, the strong trend, which has been growing since October 2015, reversed and was confidently going down for the next 4 months. The next decline of this magnitude came in May to September 2017. And pay attention to the two long-term sections, which are indicated by a blue line. They are a long-term growing and fairly narrow corridor, followed by a sharp collapse. So in accordance with this pattern, it can be assumed that this collapse has already begun, judging by the sharp fall of the price. But first, this pattern is visible only in the 5-year chart, and second, this is pure technical analysis. If you look at the dates of periods of smooth growth and sharp declines, we will again see no correlation with the summer period and seasonal factors. So the conclusion is that the effects of seasonal factors on the currency pairs seems highly exaggerated. Local price changes during holidays, national holidays, New Year may indeed take place, but there is no clear pattern. We also see no pattern of volatility or flat in the summer period. So you can easily ignore the seasonal factor and rely on more serious fundamental factors. And in the end, I would like to give traders some recommendations for summer trading. Do not fall into concerns that summer is a special period compared to other seasons. The markets are cyclical and trading is different from season to season. Then believe in yourself and stay alert. Force majeure is possible in any season, and in most cases the market is almost independent of the season. The only exception is the New Year holidays. So learn to assess the strength of fundamental factors in a given trading period. Remember that factors can differ in terms from their strength, but seasonal factors does not play a significant role in this. However, In winter, traders should be more careful. As you can see from the review, often you can see some pattern in December and February. Learning to use them to your advantage is another matter. But while I have debunked some myths about the summer trading, winter holidays still have a strong influence on the quotes. So the conclusion to this is that the market is dynamic no matter the time of the year. If the EURUSD is active in European session, in the Asian session, you can work with the Japanese yen. The same applies to trading at the different times of the year. Trading volumes fall in the summer, but will a trader with a capital of a couple thousand of dollars notice the decline? I don't think so. Factors may apply to individual assets, but if we are talking about the geopolitics, seasonal factors does not matter. So do you really want to make money? Then let go of the line, dates, seasons, and try to look for patterns. Learn to feel state of the market intuitively, be prepared for any development of events, and Lady Luck will definitely smile at you. What do you think? Is there any difference between trading in the summer and other seasons? Let me know in the comments below, and with that I will end the video. So thank you for watching, guys, and till next time.